Hey, Daryl, I'm sure you get calls from clients all the time. Do I put more money into the NASDAQ right now? What do you do?
Yeah, we still actually like technology here and communication services and consumer discretionary. It's interesting when you dissect the numbers, Andrew. So the top 5 companies that we always talk so much about that are concentrated in the S&P are up 35% year to date. If you take the bottom 495 companies, down 6% year to date. So you can see the divergence, right? The rest of the market is not participating. Those companies are still producing good top line growth, good earnings. So yes, you have to continue to add money there.
Real quick, because I want to get back to Chris before we go. Just, Daryl, is that a multiple expansion story, or you think a fundamental story?
It's both. I mean, multiples are expanding undeniably, but you still have the best fundamentals, the best sales growth, the best margins in that sector. So you've got to go where growth resides in this type of market, and we still think that that's the place to be.
Chris, do you pull your hair out, if you will, and say to yourself, what's going on in the equity market, or no? This all makes a lot of sense to you.
Well, no, it actually really doesn't. You know, there's something that's not being discussed consistently enough, and what is the long-term impact of Fed intervention in the bond market on the end investor? And I think this is something that needs to be discussed because as the market is starved for yield, what it's causing is effectively end investors to have to go further and further out in terms of credit quality in order just to get a decent return on yield. So the risk of the market is now being held by the pension funds, the 401ks, the 529s in a way that's never been seen before. So the Fed believes it's putting liquidity into these markets, but effectively what it's doing is it's starving the end investor. Now, where this manifests itself is where you see pension funds moving forward where they're not able to hit their yield bogey. And then we have a crisis on our hands in terms of, the shortfall between a corporate pension plan's obligations and what they actually have in the kitty.
Well,
and so this is something that takes a long time to manifest, but Fed intervention in terms of keeping interest rates artificially low has basically been going on since the 2008 crisis. And now they've pushed their foot a little bit further down on the gas pedal. And it's just really creating a situation where people are unable, at least through the safety of the bond market, to actually see any meaningful return in their portfolio.